From adding 1 trillion yuan more of stimulus in order to rescue growth, to planning $29 billion in special loans to troubled developers, yuan slump is forcing China into a balancing art of help recovery. Aside from that, they are also probing property executives for possible law violations. We'll be sharing recent developments coming up in the Chinese economy, so stay tuned while you smash that like button. China, with an additional 1 trillion yuan, $146 billion, in financing, increased its economic stimulus measures. However, the support likely won't be sufficient to offset the harm caused by recurrent COVID lockdowns and a decline in the housing market. This is, in fact, containing additional 300 billion yuan that state policy banks can spend on infrastructure projects on top of the 300 billion yuan already announced at the end of June. The State Council, China's cabinet, detailed a 19-point policy package on Wednesday. The exciting thing is that 500 billion yuan will also be given in special bonds to local governments from previously unused quotas. According to a readout from the official broadcaster CCTV, the State Council pledged to employ, quote, tools available in the toolbox, end quote, to maintain a fair policy scale in a timely and decisive way during a meeting headed by the Premier of China, Li Keqiang. Economists were rather pessimistic about the measures, but financial markets remained quiet. We see that this distrust or pessimism among economists is not without reason. I mean, why wouldn't they, considering the state of the financial market? We've seen that the 10-year government bond rate increased by 2 basis points to 2.65%. According to Goldman Sachs Group Inc. experts, the initiatives outlined on Wednesday would not be enough to push the total growth rate over the 3% they had predicted. The State Council also stated that the economy would not be saturated with excessive stimulus and that China will not overdraw on policy options to defend longer-term growth, reaffirming the rather cautious posture policymakers have taken towards stimulus this year. According to Bruce Pang, head of research and chief economist for Greater China at Jones Lang LaSalle Inc., the meeting sent a signal that no one should expect massive additional stimulus. The government's stated official gross domestic product growth objective of, quote, about 5.5%, end quote, has been well beyond reach because of the real estate collapse and China's stop-start reopening from COVID lockdowns. Officials are now disregarding the aim of the COVID-0 objective. Economists surveyed by Bloomberg predict a growth of less than 4% this year. Now, given that the predicted amount of unused quota might be as high as 1.5 trillion yuan, the 500 billion yuan in extra local government special bonds this year is less than some experts had anticipated. Compared to the past years, local governments have hastened the issuing of the bonds, which are a significant source of funding for infrastructure projects. As a result, they have already used up the majority of the 3.65 trillion yuan official allotment established at the beginning of the year. The economists at Nomura Holdings Inc., led by Lu Ting, stated on Thursday that the measures don't alter the game. They said in a research note that this is mainly because the real estate market is still in terrible difficulties and that throughout prior easing cycles, real estate was a big factor in driving up credit demand among individuals, businesses, and local governments. On Wednesday, the State Council also committed to approving a number of infrastructure projects. According to the statement, local authorities are urged to support a reasonable housing demand by utilizing city-specific lending regulations. Support was also given to state-owned power-producing enterprises, which would be permitted to issue 200 billion yuan of bonds in the midst of an energy crisis brought on by drought. Subsidies of 10 billion yuan will be given to the agriculture industry. The State Council also promised to keep financing costs low and to bring forth policies to aid in the growth of platform firms and private enterprises. Looking into China's plan to hand out $29 billion in special loans to troubled developers, we see that in order to ensure that stalled housing projects are delivered to customers, China will issue 200 billion yuan, $29.3 billion, in special loans, according to sources with knowledge of the situation. We can see how this will increase funding assistance for the country's struggling real estate market. The previously unreported size of the lending program, which China's Housing Ministry, Finance Ministry, and Central Bank announced with few details some late Fridays back, would make it Beijing's largest financial commitment to date to contain a property crisis that has seen home prices fall and real estate sales plummet. After placing down payments and taking out loans on apartments that cash-strapped developers are now failing to finish, hundreds of thousands of middle-class Chinese people are stuck in limbo. In the politically delicate period leading up to the Communist Party leadership transfer later this year, some homeowners have begun to refuse to make mortgage payments, jeopardizing societal stability. According to the persons who asked not to be identified because they were sharing private information, the People's Bank of China and the Ministry of Finance would channel the money through policy banks such as the China Development Bank and the Agricultural Development Bank of China. The special loans will only be used on residences that have been sold but have not yet been completed. The PBOC, the Ministry of Finance, and the Ministry of Housing did not immediately reply to demands for comment. What was said was that analysts view the central government's introduction of bailout funding as the first meaningfully positive development in the past 5 to 6 weeks. This was said by Nomura Holdings Inc. analysts Zhizhou Dong and Stella Go in a note. To be effective, they estimated that the money would need to reach at least 200 to 300 billion yuan as an initial investment. Under pressure to increase total lending to assist the country's ailing economy, Chinese banks slashed benchmark lending rates for the second time since May 20. This happened after the central bank unexpectedly reduced its main policy rate to promote growth last week. Rate reductions were the most recent in a string of measures taken to support the real estate industry as the liquidity crisis heightens a recession in the second largest economy in the world. At the moment, youth unemployment in China is at a historic high of 20%, and the country is on track to fail its annual growth target of about 5.5%. Also, to relieve a liquidity shortage, China permitted banks and bad debt administrators to relax some loan limits earlier this year. To assist in resolving difficulties at a dozen sizable real estate companies, including China Evergrande Group, the central bank met with approximately 20 key banks and asset management companies in April. Banks are, no doubt, hesitant to lend because of China's relentless pursuit of COVID-0, which has resulted in repeated lockdowns and a rise in bad debt. According to Bloomberg intelligence analyst Christy Hung, bank loans to the real estate industry have decreased for the first time in 10 years, and the dip may continue. We see that this is true in relation to the recent yuan slump and how it is forcing China into the balancing act. Take note that the Chinese yuan's drop or slump to its weakest level versus the dollar in over 2 years adds to Beijing's already hazardous balancing act, which is looking for measures to prop up its faltering economy without causing financial turmoil. The decrease in currency rate creates opportunity by cushioning exporters and providing an extra source of assistance when the People's Bank of China reduces interest rates and provincial governments borrow to build projects. Authorities have been attempting to put a floor under a slowdown caused by China's escalating real estate crisis, as well as a continuing knock to consumer and corporate sentiment, heightened by a stop-start COVID control effort. According to Jean Ma, top China economist at the Institute of International Finance in Washington, yuan depreciation seems one last policy option left. Housing has not responded to policy easing, and because loan demand is so low, monetary policy has been mired in a liquidity trap. However, a weakened currency also causes market instability and capital flight to intensify. The gap between the financial markets in China and the US, where the dollar is close to a record high, will widen the more the yuan is permitted to depreciate. Already, the two major central banks in the world have begun moving in opposing directions this year. Emerging nations, which in recent decades have relied on the yuan as an anchor of stability thanks to soaring trade flows, might potentially be threatened by the volatility. Given that many of them sell the commodities and input goods required to feed manufacturing supply lines in the second largest economy in the world, China's sharp slowdown is already having an impact on some of its most vulnerable trading partners, including South Korea, Singapore, Malaysia, and Taiwan. Dave Lovinger, managing director of TCW Group Inc. in Los Angeles, said that many developing market nations now have China as their largest trade partner, and as a result, they and their currencies have become increasingly connected to China's cycle. He also said that as China's proportion of trade with developing economies has increased, notably in Asia, the moves in emerging market currencies for the yuan have grown increasingly connected. For China, a noticeable yuan depreciation would hasten the flow of investor capital out of the economy and put pressure on individuals, businesses, and families to transfer their savings abroad. After a sharp decline in value in 2015, the government was finally obliged to exhaust $1 trillion in reserves and impose stringent capital controls that made it even more difficult to move money in or out. Despite the fact that the onshore and offshore yuan are both at their lowest points since September 2020, the yuan's slide appears to have, for the time being, stayed inside the comfort zone of the authorities. This quarter, the offshore yuan lost around 2.4%, making it Asia's second worst performer after the South Korean won. But yuan weakness is predicted by analysts from Standard Chartered plc and Mizuho Bank Ltd, as the PBOC's dovish policies will diverge more from the Fed's hawkish ones. The outlook for China is still precarious, as experts have warned of even worse economic growth and demanded further stimulus measures, such as further reductions in policy rates, bank reserve ratios, and increased government expenditure. The gross domestic product growth predictions for this year have been lowered to 3% or less by both Goldman Sachs Group Inc. and Nomura Holdings Inc. So far, that's it for the yuan slump. Before we come to the end of this video shortly, let's see how China plans to probe property executives for possible law violations. And if you have watched this far, remember to hit that subscribe button. Recent findings tell us China is investigating a number of executives at state-owned real estate enterprises, marking an extension of the government's anti-corruption campaign, which has primarily targeted the financial and technological industries. Authorities announced in the recent past that they were probing at least 4 current and former senior executives, including Xiamen CND Real Estate Chairman Zhuang Yukai, who is accused of severe legal crimes. President Xi Jinping's anti-corruption crackdown on the country's enormous financial industry has resulted in the dismissal of more than 40 officials from state institutions and regulators. The fresh investigations may indicate that authorities are broadening the effort to encompass the struggling real estate industry, which is already dealing with a devastating slump that is harming the world's second-largest economy. According to Ting Meng, senior credit analyst at Australia and New Zealand Banking Group Ltd, the probes may give further damage to investor confidence and trigger market concerns about the internal control of some state-owned firms. She said that, however, the influence on the firms may be limited because decisions at SOEs are typically made by many people. Other real estate executives being probed include Shi Zhen, chairman of state-owned CND Urban Services, on suspicion of unspecified violations, Liu Hui, deputy general manager of state-owned Shenzhen Talents Housing Group, for serious law violations, China Resources Land Ltd's former chairman Tang Yang for severe disciplinary and legal violations. Because of Xi's crackdown on significant segments of the private sector, such as the real estate sector and major technological businesses, investing in China is becoming riskier. This year, a number of China Construction Bank Corp officials have drawn attention to their connections to real estate investors.